Hello, everyone. Welcome back to another edition of the Week in Charts. Charlie Bilello here. I'm your host, and I'm going to walk you through some of the most important charts and themes that I'm seeing today in markets and investing. If you're watching this on YouTube, take a moment, hit that subscribe button for more content just like it. And before we begin, I want to talk about this exciting offer from my firm, Creative Planning. Go to creativeplanning.com/Charlie. Fill out this form to schedule a call or a meeting with an advisor today, and you're going to get a free wealth path analysis. And with that, we're going to take a look at your portfolio. We're going to make sure you're on the right path to financial independence. We're going to give you some proactive tax strategies, and we're going to do an insurance and estate planning review, making sure all of your assets are protected and your documents are in order. At Creative Planning, we're in all 50 states, so we likely have a location right near you, over $325 billion in assets under management and advisement, and we're here to help. So go to creativeplanning.com/Charlie. Here's what's on the docket today. A lot of important topics to talk about. We have to start out with the jobs market, showing some resiliency there. People were expecting a weak report. That didn't happen, but there are still some signs of labor market cooling. I want to run through that. Big shift in Fed expectations after that jobs report. A bond market got ahead of itself. Huge return over the last 5 months, really front running the Fed. I want to talk about where that stands today. Chinese equities going vertical, one of the biggest advances we've seen in history for that market. Number 6, declining dividend yields in the U.S. We'll talk about valuations ahead of earnings coming out starting next week. And number 7 here, we end with something positive every time on the show, and that's more affordable rents. Great news for anyone in the rental market. Okay, number 1, the resilient jobs market. We got that September jobs number, 254,000 jobs created in September. The expectation was 150,000 jobs, so much better than expected. I don't like to put too much emphasis on any one month because we know these numbers often get revised and revised significantly, but notable, it was above expectations. And also we have positive revisions for the prior 2 months. August revised up 17,000, July revised up 55,000. So jobs market not dead just yet. 45 now consecutive months of positive jobs growth in the U.S. Where are the jobs coming from? Top 3 sectors. This is a consistent theme over the past few years. Number 1 for September, leisure and hospitality, 78,000 jobs added. Number 2, healthcare, secular trend. You're going to see this at the top of the list almost every month, 72,000 jobs added there. And government, number 3, government adding a lot of jobs in the past few years, 31,000 jobs created in September for the government sector. Now, unemployment rate, here's the big one, moving down once again to 4.1%, was 4.3% 2 months ago. So 2 ticks lower now in a row. This is something the Fed is looking very closely at. And the expectation was that perhaps this would continue to trend higher after hitting 4.3%. But we talked about some of the reasons perhaps that it might move down again. There was some seasonal weakness in Texas that was driving the rate a little bit higher a few months ago. And that seems to be the case with the move back down to 4.1%. So better than expected on the unemployment rate. And hourly earnings here, we had the one of the biggest upside surprises, I would say, in this report was from this hourly earnings, 4% increase over the past year. The expectation was for a 3.7% increase, so well above expectations. And this is something that the Fed looks very closely at. It's an input in terms, of course, for a lot of employers in terms of what their cost structure is. So it's likely to lead to, all else equal, higher rates of inflation. So looking at 4% over the past year, going to be very hard to significantly reduce that inflation rate. Of course, this is good news for American workers. Your wages going up 4% over the past year, which is above the rate of inflation, likely to be around 2.3% when we get that report later this week in terms of CPI. Okay, what are the negative sides for the job market? What are the signs in terms of cooling? Well, instead of just looking at one particular month, we should really look at the year-over-year change in jobs growth, and 1.6% was that rate of change in terms of the cumulative number of jobs in the US, 1.6% increase. You can see that the growth rate there has been slowing and slowing and slowing in recent months. And we're kind of back to where we were right before COVID. So, normalization of the labor market, I'd say there's a pretty good balance now between supply and demand. This is an interesting one here, looking at the percentage of workers quitting their jobs. When more workers are quitting their jobs, that means they're more confident they can find a new one. That tends to be associated with more job openings. And we've seen job openings come down, of course, over the past few years from record levels. So we had 3% of workers quitting their jobs just a few years ago, and now we're at 1.9%. That's the lowest since June 2020, below the historical average of around 2%. So workers less confident they can find a new job, so fewer workers are quitting their jobs. And this kind of confirms that, looking at the data of wages of job stayer versus job switcher. A few years ago, we had really a record spread between the two, talking about 8.5% increase if you switch jobs in your wages, and 5.9% if you stayed at your job. So huge spread. You got a huge benefit from switching jobs. That was right around when inflation in the US was peaking in the middle of 2022. But if you fast forward to today, that gap has been closed. So now, over the past year, you're actually looking at slightly higher wage growth for job stayers at 4.7% versus job switchers 4.6%. And during recessions, of course, what do you see? If we go back to this chart here, you see fewer and fewer workers quitting their jobs, of course, because they're not confident that they could replace them with a new job. And you actually see that job stayer being paid more than the job switcher. So we'll see if this trend continues, but certainly where we are today, a much more balanced position between supply and demand in the labor market. But if we look at this cooling, it's really not a cooling so much in terms of companies hugely increasing layoffs. We certainly aren't seeing that so far. What we are seeing, though, is companies pulling back on hiring plans. This is the latest data from Challenger, Gray, and Christmas. We have data now through September, and what we're seeing on a year-to-date basis, 483,000 hiring plans, and that's down 33% from where we were at the same point in 2023, and it's actually the lowest year-to-date hiring number since 2011. So you got to go back a long ways to find fewer hiring plans announced at this point in time than what we're seeing today. But in terms of that layoff side, we're not yet seeing it. Where would that show up? Well, it would show up first, I think, in initial jobless claims. And we said this is going to be the number to watch. So continue to watch this closely, but it continues to trend lower. So it was trending higher for much of the year. Early August, we got that bad payroll report. And since then, we've seen a reversal in this number. Now continues to trend lower. Very similar to what we saw actually in 2023, where the first half of the year, it trended higher. Back half, it trended lower. So watch this very closely in the coming months to see if this will continue. So what happened in terms of those Fed easing expectations after the payroll report? But what we saw was a huge shift in terms of those expectations. Really off the table after the report was the idea that the Fed would cut 50 basis points again. So what I'm showing you here is the expectations for that November meeting, and where the market is right now is 89% chance the Fed will cut 25 basis points in November, bring that Fed funds rate down to 4.5 to 4.75%. And they actually have a slight chance of no change in the Fed funds rate. I don't think that will happen. I think the Fed wants to continue easing, and barring something crazy in terms of the inflation data in the next month, I think you're going to see another cut, and the market's pretty confident now that's going to be 25 basis points. And then for December, market's saying another 25 basis points. That will bring the Fed funds rate down by the end of the year down to 4.25 to 4.5%. And you could see the curve here. End of the year, we're in that 4.25 to 4.5%. But the big shift after that employment report was the expectations for 2025. Market now expecting 3.4% for the year-end Fed funds rate at the end of 2025. It was expecting around 2.8%. So big shift in terms of the expectations for 2025. And really the market had gotten too aggressive in terms of those easing expectations, assuming we're not in a recession next year. What's really the rush for the Fed to really bring that rate down, knowing that we still don't have the inflation rate at 2%, which is their target. So if we look at that expectation for 2025, you're now right in line with what the Fed is projecting for that year, 3.4% at the end of the year. And this is assuming they have the unemployment rate at 4.4% and they have core inflation coming down to 2.2%. So obviously, we're going to get a lot of data between now and then, but interesting to see that big shift in terms of expectations since that employer report where the market essentially saying Fed's not going to be as aggressive as they previously thought in bringing down that Fed funds rate. Okay, so what about the bond market here? It really got ahead of itself in terms of expecting really massive easing this year and next year. And what we saw in terms of the bond market's gain here is kind of historic. Last 5 months, 8% increase for the Bloomberg Ag Bond Index. That was the biggest 5-month gain we've seen since 1995. 1995, another year the Fed started cutting interest rates. So no surprise there. But really, what we're saying here is the bond market was front running that Fed move. So in anticipation of a lot of interest rate cuts, the bond market was moving higher and longer term yields were moving lower at a rapid pace. So over the 5 months ago, you had a 10-year around 4.5%. It got as low as 3.6%. So almost 100 basis point move lower in 10-year yields by the time the Fed is actually cutting rates in September. And since then, this is pretty interesting. Rates haven't gone down on the long end. They've actually moved up. So we've moved up from about 3.6% to a little over 4% again. You can see bonds cooling off a little bit here after that historic rally. So that's, I think, an important point for bond investors to understand, that just because the Fed cuts shorter term interest rates doesn't mean the long end of the curve has to come lower. There's no real set formula between the two. Now, of course, if the Fed cuts interest rates back to zero, well, then you're likely to see an impact on that long end. But assuming that the Fed only cuts to, let's say, 3.3% by the end of the next year, there's no way you can predict where the 10 years can be. It could be higher, it could be lower. But the big point, I think, is that the move lower we've seen in the 10-year yield over the past year from close to 5% down to 3.6%, it priced in a lot of that easing already. So if we're looking at another reason to suggest maybe that 10-year is going to stay elevated here or stay at 4%, instead of going back down to less than 1% like we had in 2020, well, national debt to me would be one of the big reasons. You just have a big increase in supply and the supply keeps on coming. So what I'm showing you here is the change in U.S. national debt since the debt ceiling was suspended back in June 2023. And it's a massive increase, 4.2 trillion. And we just passed 33 trillion back in July, and we're past 35 trillion back in July. We're already at 35.68 trillion. So just a massive amount of debt being added in the last few months. So I think that's just an additional reason to suggest higher long-term yields. And this will be the big question. As the Fed continues to cut interest rates, that 3-month Treasury bill yield will definitely come down. The Fed is controlling 1-month, 3-month Treasury bills. So shorter end of the curve, the Fed has absolute control. The big question will be the longer end of the curve, what's going to happen with the 10-year yield? And no one knows, because that's dependent on long-term inflation and growth expectations, which are going to be changing. So if there's a recession next year, growth slows, inflation expectations come down, you're likely to see that 10-year yield move lower along with that. No recession, let's say growth is stronger than expected, inflation picks up again, well, perhaps you could see that 10-year yield start to move higher. So no set formula between Fed funds rate and what that 10-year yield is going to do. So let's talk about China. Really, stock market going vertical, something we've only seen a few times in history. What's driving it? Stimulus announcement, massive, 142 billion to 284 billion. They're lending money, they're lowering reverse repo, they're expected to lower their central bank policy rate. They're making loans to shore up the stock market, relief for home buyers, a lot of different things. China early in the year announced this plan for the government to actually start buying equities, 278 billion. I don't know if they actually did that much or how much they did, but certainly I think a big factor in announcing all this stimulus, if they bought up all of those equities, was saying, well, nothing's happening in terms of the stock market. Perhaps we should try to manipulate it and pump it higher. And that's exactly what's happened over the past few weeks. 13 days, 40% increase in Chinese equities. Only October through December 2008, we saw two other times where it was up more over a 13-day period. So really historic. And if we're looking at the global equity markets, China's gone from really one of the worst performers this year to the best performer by far. MSCI China ETF up 47% now year to date, well above the S&P 500's 21% advance. Sentiment, of course, completely changed. You had people saying it's uninvestable in February. China's stock market's in free fall in January. And today, Goldman Sachs is urging their client to get on board, essentially saying this time is different in terms of their policy response. If not now, when? 10 reasons to buy China equity. BlackRock, bullish, telling clients it's taking an optimistic view, expecting fiscal stimulus to come. And if we look at daily trading volume here, this really tells the story. Huge spike in speculation. So the amount of value traded in Chinese equities up 6 to 7x over the past few weeks. And what investors should be asking is this sustainable? Is this advance going to continue in the future? And just based on the historical data, there's really no way to say one way or another that this is going to continue. We've had times where it did continue to go up over the following year. That would be following November 2008 and December 2008, but everything went up a year following that. That was during the depths of the financial crisis. If we look at periods like 2022 or October 2007 or 2015 here, April 2015, not so good for Chinese equities going forward. So we'll see. There's no way to predict what's going to happen. A lot of this is sentiment driven. The stimulus, what I will say about that is it has to actually translate into confidence from investors that you're going to see real profit growth from these Chinese stocks going forward, and B, more confident that the Chinese government isn't going to get involved in a negative way influencing these companies, which was happening for the past few years, which was a big part, I think, of the declines there, was fears over Jack Ma's disappearance and a lot of other different things to suggest that the Chinese government was getting way too involved in the financial markets, and just simply, can you trust the fundamental data out of China? So if this is going to lead to a sustainable advance, I think we have to see China moving back to the policy of increasing capitalism, increasing free markets, more transparency, more trust, and that might lead to something sustainable. But absent that, it's hard to suggest that this is going to be something long-term. And certainly you wouldn't suggest that we're in a better place for Chinese equities than we were 13 days ago. So all of these strategists coming out now that are suddenly bullish about Chinese equities, well, they have to take a good hard look, because if you were saying that Chinese equities were cheap, and they certainly were a month ago, well, after a 40% rally, well, that changes things, unless you're saying that we're going to have a big boost in terms of earnings going forward. I haven't read anything to suggest that's going to happen, but perhaps that's part of what's being priced in. And that's why markets are interesting, because you have these things seemingly out of nowhere. You have this huge advance, huge speculative advance, and nobody saw it coming. And then all of a sudden, everyone's suddenly bullish about it going forward. The big question, I think, in terms of secular moves is this finally the low for emerging markets? We just had a downtrend, 13 years of a downtrend for emerging markets, finally outperforming the US, but still underperforming on the year, which is kind of amazing. Even with this move higher, even with China leading all markets year to date, still underperforming if we look at emerging markets as a whole. And China's influence in emerging markets had been going down very rapidly because of China's underperformance. But now we're seeing a shift back in the direction where it's becoming very important again after that 40% event. So now you have 27% of emerging market ETF, the iShares ETF in China. And in June, it was at 22%. And so India had almost caught China back then in terms of its weight in this index, which is pretty remarkable because of that huge India rally over the past few years and the fact that China has underperformed by such a massive amount. So if we're looking at long-term secular cycles in terms of emerging markets versus US, you can see here in the chart, it's really been flipping back and forth. If we're starting in 1989, EM outperforms until 1994. Then you have the huge technology boom in the US stocks outperforming through 1998. EM takes leadership again until 2010. And then since then, it's been all about the US massive outperformance and the longest period of outperformance we've seen for US equities and histories. And you can see here on that right side of the chart, that's the EM outperformance over the past few weeks. As you can see, it's barely anything. So if this is a secular change, there's obviously a lot more upside for emerging markets and a lot more upside in terms of outperformance. And the best thing you can say about emerging markets, we've been saying it really for the past year or two, is the sentiment is so bad for emerging markets. Valuations are cheap. So you have this opportunity for an upside surprise. So will that happen? Nobody knows, but that's why you have a diversified portfolio because of these periods like 1999 to 2010, where you have emerging market outperformance. If you own a globally diversified index, your EM weight is around 10%. So not huge, but if you have this huge cycle of outperformance, that certainly can be beneficial to you. So in a diversified portfolio, something is always outperforming, something's always underperforming. What's been outperforming over the past decade plus has all been about US large cap growth stocks. And as we've been talking about all year, are we seeing a change here? Are small caps going to start to lead? Are international stocks starting to lead? Are value stocks starting to lead? Are we finally seeing this change in secular trends? We don't know. We'll only be able to answer that question in hindsight, but that's why you have a diversified portfolio in advance, because by the time you have this huge spike higher in any one of these areas, it's too late then to start thinking about diversification. Okay, number 6 here, declining dividend yields. Really a fascinating look here at the US equity market in terms of dividend yields. 1.27% is the current dividend yield in the US. That's tied for the lowest level we've seen since 2000. Obviously, 2000 being the big market peak back then when valuations hit their highest levels in history for the US market. So, question is this a big concern or should this be a big concern? Certainly is a reflection in part of how much prices have run up over the past few years, far outpacing obviously the increases in dividends, and that would lead that dividend yield to decline, and that's what it's been doing. But of course, we shouldn't be looking just at dividends because nowadays there's massive buybacks. That's the other way to return money to shareholders. So if we're looking at the dividend yield plus the buyback yield, yes, it's come down, but not at the levels yet that we saw, let's say, just a few years ago, 1.9%. So well below historical averages. Yes. Are we at the lowest levels ever? No. What I would focus more on is valuations and expectations rather than just looking at dividend yields and buybacks. And if we go back to that chart I've been showing of price to peak earnings, well, that suggests that prices have run up much faster than earnings. And we're at the highest valuations we've seen since 2000, but still a ways off from that 1999-2000 peak of around 29 times. So we're about 25 times peak earnings for the S&P 500. It's about 50% above the historical median. So certainly not cheap. The question going into earnings season is, are these companies going to start to show the massive profit increases that I think this is reflecting? This is reflecting a huge boom in AI and for that to start to show up in the bottom line for companies. If we look at the top line here, we're almost at a record in terms of the price to sales ratio, 3 times sales for the S&P 500. Only in 2021, right before we had the bear market, the peak around there was 3.04. We're almost there in terms of the highest price to sales ratio in history. And this simply means expectations are very, very high right now for the US equity market. And if we don't have a strong earnings season, it'll be really interesting to see what the reaction in terms of investors is. Do they sell into that if the earnings don't meet expectations? Okay, we'll end as we always do with something positive. More affordable rents. This is something I've been talking about month after month because the trend has really continued here. Another year-over-year decline for asking rents. Data from Apartment List shows 0.7% decline over the past year. You can see nominal rents, according to Apartment List, actually peaked in 2022, $1,441 a month. We're now at $1,405 a month, so lower than where we were a few years ago. And we're entering the seasonal period where rents actually come down a little bit. So that's likely to trend lower in the coming months. And this is a new concept that I've been showing here, which is adjusting rent increases for wage growth. So as we talked about earlier, hourly earnings are up 4% over the last year. We have rents down 0.7%. So that's making rents more affordable, which is great news. And you can see here that inflation adjusted rent is now at its lowest levels since early 2021 and lower than actually where it was in 2017 when this data set first begins. So great news. And that's largely driven by the supply demand dynamics in the rental market, very different than the housing market for purchase. Houses and apartments for rent, much more driven by the simple fact that we have rising vacancies and a lot more demand in terms of huge construction boom in multifamily housing in the past few years. That's leading to higher vacancy levels, much more pressure on landlords not to increase rents when they have these vacancies, and perhaps even to lower asking rents to incentivize new renters to come in and rent that particular property. So great news, because this is the biggest factor for most people in terms of their budget, is what they're spending on housing. And the more affordable this becomes, the more money they have to spend elsewhere. So it's a very good sign for the overall economy is having lower priced housing. So hopefully this is a trend that continues. Okay, with that, we'll end it right there. Thank you everyone for joining me this week. Have a great rest of the week. If you're watching this on YouTube, hit that subscribe button. I'll see you next time on the Week in Charts.